So we've got Abbott Company, and they are preparing their statement of cash flows for the year. Now in this question, we only need to figure out what they should report as cash outflows for the financing activities section of their statement of cash flows. So let's bring up our little visual on the financing section that we'll use to guide us through this question. So we'll go through each of these three items, classify them to either the financing section or another section, and then figure out what the total amount for the financing section would be. So on the first item here, payment of interest on bonds payable for $500,000. So this one can be tricky, right? Because bonds, those are included in the financing section, but only the actual bond as a principal side of things, right? When it comes to interest, whether it's being paid or received, we're always going to report interest payments in the operating section. So that's going to be excluded from the financing section here. How about payment of dividends to stockholders? So dividend payments, we pay those to common or preferred stockholders. And as we can see in our financing section visual, that's number 4 under equity financing. So that's definitely going in the financing section of our cash flow statement. And that's going to be an outflow for $300,000. And on the last one, payment to acquire 1,000 share of Marks Corp for $100,000 worth of debt securities that are classified as trading. So when it comes to trading securities, those are going to be recorded in the operating section. So that is not going to be in the financing section. But even if these were classified as available for sale or held to maturity, they would be in the investing section. So no matter what, when we purchase securities, whether it's trading, AFS, or held to maturity, those will not be included in the financing section. So the only item that's coming in the financing section here is going to be the payment of dividends to stockholders for $300,000. So $300,000 is the correct answer.
Equivalents have a maturity of 3 months or less.
So this is a fairly basic question on the direct method and what gets included in the direct method. And as we can see in our visual, well, it's quite simple. For the operating section under the direct method, all we do is summarize cash collected from customers, and then we reduce that amount by cash that is paid out for operating expenses, and we're left with the net cash flows from operating activities. So when we read through, right, cash paid to suppliers, that's definitely going in the operating section. How about cash received from customers? That's definitely going in the operating section. Same with cash sales. Now the only one here that is not going in the operating section under the direct method is going to be issuance of debt. That is a financing activity, and that's going to be true for either the direct method or indirect method, right? Again, that's going to the financing section. So the question is asking which of the following wouldn't be included in the operating activity section. So that's going to be issuance of debt. So that's our correct answer. So we're back at the Longhorn Beach Club, and this time around they need us to prepare the operating section of the cash flow statement. And we should know that we can either use the direct or indirect method. Now Longhorn Beach Club, they have chosen to use the indirect method. So we need to understand how to perform that setup. So for the indirect method, we have our mental map. It's really a 3-step process. The first piece is we always start with net income, and then we adjust for any non-cash expenses and gains or losses. And then in step 3, we need to adjust for fluctuations in current assets and current liabilities. And that's basically just the change in the amount. So let's start with step 1. So in step 1, we locate net income, and that is $2,665,000. So we'll add that to our indirect method cash flow statement. Now in step 2, we need to adjust for any non-cash items as well as gains or losses. So one of the most common non-cash items is depreciation and amortization, right? There is no cash flow impact. And we always will add that back because it's an expense that reduces net income. So we'll add back $125,000. So you can see that in our table. And then we're going to add back for any gains or losses. So one of them here, right, is the provision for losses on accounts receivable of $15,000. So that loss of $15,000, that reduces net income. So for the cash flow statement under the indirect method, we're adding back that $15,000. So that's why it's positive. And then the next item is the gain on sale of equipment for $155,000. Well, that full proceeds from the selling of equipment, right, that goes in the investing section. But in the operating section, we need to remove or reverse out any gains. So that's why it's going to be a negative $155,000 for the operating section. So now we're ready to move to step 3, where we need to calculate the impact from any changes in current assets or current liabilities. Now in this question, there's only current liabilities. We had an increase in income taxes payable of $32,000. Well, anytime a liability increases, that is a positive impact to our cash flow statement. So that's going to be plus $32,000. The same holds true for the increase in other liabilities of $18,000. So we're also going to add in a positive $18,000. So now that we've classified every item listed in the question, we're ready to calculate the net cash flows from operations, and that's going to sum to $2,700,000. So that's the correct answer. So before we dive into the details of this question, I want to make one thing super clear. It's that we don't actually need to understand the true accounting behind all of the information in this question. We just need to understand basics of accrual accounting and when to recognize something, how to record it on the balance sheet, and then when it can be realized later on, right? This unique situation is not something you need to fully understand, because I can promise you this is not, a typical accounting concept that you'll have to really understand the technical details behind. But essentially what's going on here is that a company, they're starting in a new area. For whatever reason, this state says, okay, you're going to pay a sales tax, but to get started and get this license, you have to prepay what you believe 3 months of sales tax will be. And then at the end of 5 years, so 5 years from now, assuming that you pay all of your sales tax over this 5-year period, we will refund you the 3 months that you prepaid at the beginning of this endeavor when we gave you the license. All right, so the question is specifically asking about the 3 months of sales tax the company prepaid, and assuming that they will get this all back at a later date, meaning 5 years from now. Well, how should they record this on the balance sheet right now? Well, because they're making a prepayment of sales tax that they expect to get back, right? That's a future benefit that they're paying cash out now. So the journal entry they would record right now is a debit to prepaid asset and a credit to cash. Now, normally we think about a prepaid expense as a current asset, but we're not going to get this money back until 5 years later, assuming all goes well. So 5 years, that trips the 12-month rule. So since it's 5 years, it's going to be non-current. Right, so we're going to have a non-current prepaid asset. If it's long-term, sometimes like this, they just call it a deposit, which is essentially the same thing as a prepayment, right? It's a deposit. They're going to get this money back at a later date, but we're going to call it a prepayment. So it's going to be a non-current prepaid asset. And at the end of 5 years, assuming all goes well, they're going to get this money back, right? And all they would do is debit cash and credit non-current prepaid asset, right? So that is how the journal entries relate to this. Ultimately, at the initial transaction date when they're getting this license, they would record it as a non-current asset with that initial journal entry. Now, like I said, this scenario, do not try to get into the technical details of, okay, for this license, I need to prepay 3 months of sales tax. That is not something you need to know for the exam. You just need to understand the basics of accrual accounting, and helping to understand the journal entries will also make it a lot simpler here. So hopefully you fully understand how this transaction impacts the company's financial statements. With electric vehicle companies being hot right now, Simone is a big-time CFO, and it only helps that she's living in New York City, right? The Big Apple. So in this question, we're going to dive into the cash flow statement, read through the options here, figure out what should be included in the financing section. So off to the right, we have our financing section visual. Let's go through and see which of these items meet the criteria to be included in the financing section. So to kick it off, we have sale of equipment. Now, when we sell a piece of equipment, that is going to be characterized as an investing activity and not a financing activity. So we're going to exclude that. How about issuance of the company's bonds? Well, when we issue bonds, that is a financing activity. We can see that in our visual. So we're going to include that in the financing section. Now that's going to be a cash inflow for $10,000. How about dividends paid of $5,000? So when we have shareholders and we pay them dividends, Well, that's a financing activity. That's one of the returns on their investment. That's why they invested. So that's going to be a cash outflow of $5,000 recorded in the financing section. You can see that under equity financing, it's number 4. How about the purchase of stock of another company? So this is going to be classified as a trading security, and trading securities, when we purchase those, that gets recorded in the operating section. So this is going to be excluded from the financing section. How about the purchase of a U.S. Treasury note? Well, I know this sounds a lot like an investment or a debt security, but because U.S. Treasury notes are highly liquid, right? They mature in less than 3 months. This is going to be included in the operating section of our cash flow statement, right? It's going to be on the balance sheet. It's going to be under current assets. So this is going to be excluded from the financing section. How about income taxes paid? Well, when we pay income taxes, that's a cash outflow. That gets recorded in the operating section and not the financing section. So we're going to exclude that. And the last item here is interest income received. So regardless whether it's interest paid or interest received, it's always going to be recorded in the operating section and not the financing section. So we're going to exclude that. So the only 2 items that will impact the financing section are going to be the issuance of company bonds for $10,000, right? That's going to be a positive $10,000 because it's an inflow. But then we paid dividends of $5,000. That's negative. So that results in a net cash inflow from financing activities of $5,000. So that's the correct answer.